very short video represents the completion of the final page of chapter 14 in your workbook. Okay, you have an exercise here that talks about financial statement ratio trends. And what you need to do is indicate that the following ratio trends are favorable, unfavorable, you cannot determine. So evaluate each of the ratios based upon its own trend only. So let's start out with trend number one. We have a decrease in the price to earnings ratio. So what that means, if you remember the meaning of the ratio, is that that is the amount that shareholders or the stock market is willing to pay for the value of a company's earnings. So in theory, if the price to earnings ratio is increasing, that would indicate that's a favorable trend. In this case, since it is decreasing, that would be an unfavorable trend. Okay, now let's take a look at the debt ratio. The debt ratio is a percentage of assets that have been acquired in the company but have been acquired through third-party debt, meaning that as the debt ratio increases, in effect, the risk of liquidity to the company actually decreases. Assuming that a company takes on a lot of debt, they do have to pay that debt back over time. And if the company suffers a economic setback and decrease in their earnings, their decrease in their revenue, what's going to happen is they're going to be less likely to pay off any type of increased debt. So in this case, the ratio would be an increase in the debt ratio would be unfavorable. Okay, now we have an increase in quick assets ratio. If you remember, quick assets are those current assets that can be converted into cash very quickly to pay off current debts such as in an emergency. Now, the quick ratio means that the ratio of those quick assets to the current liability is actually increasing. So what that means is that as the ratio increases, we have more quick assets to pay down the current liabilities. So that would be considered favorable. Okay, decrease in accounts receivable turnover ratio. And the accounts receivable turnover ratio is a measure of how quickly you collect the entire balance of your accounts receivable. So if I have an accounts receivable turnover ratio of 5 times, that means I collect my accounts receivable 5 times during the accounting period. So therefore, if I have if my ratio is 5 times and it goes up to 6 times, that's an increase. And that would mean the increase in my accounts receivable turnover ratio means that I would be collecting my accounts receivable more efficiently. So in this case, this is a decrease in the accounts receivable turnover ratio, so it would be unfavorable. The next to last one is a decrease in working capital. And what that can be defined as the value of your current assets minus your current liabilities. So if you used all of your current assets to pay off your current liabilities, what's left over in the current assets would be considered your working capital. So your working capital, as it grows, means that you have the current assets over current liabilities is also growing. So an increase in working capital would be favorable, and the opposite is a decrease in working capital would be unfavorable. And the last item is an increase in return on equity. That represents the net income of the company divided by the average equity within the company. So if your net income increases relative to your return on equity, that would mean you would have an increase in return on equity. And under those circumstances, you'd be increasing your net income over your average equity. So that would be a favorable trend. And that's the end of the presentation for the last problem in our workbook. Thank you very much.